I think it's pretty realistic to start asking ourselves when Google or Alphabet will become the largest company in the world, and not if it will become the largest company in the world. It just produced one of the most impressive quarters I think we've seen from the hyperscalers thus far. The company had a huge run up into earnings and is now increasing even more post earnings. Most of the time you will see these companies take a step back unless they absolutely kill earnings reports, especially when they have that large run up into earnings, and we just are not seeing that. It's mind-boggling to see a company of Alphabet's scale and size grow as fast as it can, expand margins as fast as it can, and just put up the absurd backlog that it has. In this video, I'm going to dive into Alphabet's quarter. I'm going to dive into a bit of its valuation. I'm going to dive into, whether or not I think this is a $400 stock, a $500, a $600 stock, whatever it may be, and just kind of give my overall thoughts on it. Now, full disclosure, obviously not financial advice. Do your own research, guys. I am here to help you in your, path to researching companies, but this is not the be-all, end-all. Alphabet is my largest position in my portfolio. I believe it's just over 7% of the portfolio now. I bought the company back in 2020. I believe it's a 370, 400% position for me at this point in time. So I do own it. That is definitely going to factor into my analysis for the company. I am bullish on Alphabet, but I'm still going to provide a ton of value in this video. If you want to see earnings recaps like this, let me know. The best way to let me know is like the video, subscribe to the channel, drop a comment down below. Let me know what company you want me to cover next. Ton of these hyperscalers reported all in the same day. And if you want to see my top 4 holdings, I have a report in the description, in the comments down below. But let's dive right into the quarter. And it was a mega quarter. When we look to revenue, 22% increase, 19% on constant currency. We're looking at total revenue of, effectively $110 billion. This was around $3 billion, I think, above consensus estimates. So beat in that regard, low single digit beat. When we look to net income, this is one thing. It increased 81%, earnings increased 82%. This is what you're going to see on most headlines. But the one important thing to factor into this is the fact that I believe just under half of these earnings are from gains, unrealized gains on its Anthropic investment for the most part. True earnings came in around $2.70, I think, which is still ahead of estimates, but this number is a bit misleading. It's not like this isn't actually, Alphabet's true earnings. It's just when you adjust, one-time swings in equity investments, it's not, 82% higher. But we're seeing large growth across the business. We're looking at Google services, 16%, 19% in Google search. Now, this is the platform that effectively everybody was leaving for dead 2 or 3 years ago. ChatGPT was going to kill Google search. It was going to kind of, limit the queries that people were going to in regards to Google. They were going to go to ChatGPT instead. The moat was done. It was finished. The 90%, market share in search was toast. Queries are at an all-time high in Google search. They are getting more search requests now than they ever had. And this is because of that, the AI overviews, the AI mode. People are using Google. They're using Gemini. They're more than ever before. If this bear thesis wasn't dead, I think it was dead, but this quarter just kind of proves it should be officially laid to rest. Now, when we look to YouTube, 11% in YouTube ads. And this has kind of been the darling of the company, I guess you could say, over the last while, outside of cloud. Cloud has been the main driver, but YouTube has been, it's been the diamond in the rough here, growing at a very strong pace. And the one thing I think for YouTube, the one thing that has made YouTube very popular, if we think about the ability to create video ads pre a lot of this AI, it was very tedious. You needed actors, you needed a scene, you needed camera equipment, you needed whatever it may be. You had to take 1 billion different shots of this video. You might put it on YouTube. It might be a complete dud. The text-based ads that you see on Google search or whatever, those can be modified, tweaked, whatever it may be, for very little cost. Whereas YouTube, the video ads were often a burden. AI ads, and you could argue all you want that there's a lot of AI slop ads on YouTube. I tend to agree, but it has reduced the barrier for people to advertise via video dramatically. You can now go on, get a YouTube ad up and running, whether it be with something like Canva, whether it be with, I don't know, any other type of AI video generator, and you can get that on YouTube ads in no time. Barrier to entry has effectively gone to zero. And for this reason, they're seeing large-scale growth on YouTube ads. Now, are they good ads? No. But, I mean, ultimately, if they're willing to pay Alphabet to run them on YouTube, that's just more money for Alphabet. So we look to Google Cloud, which is the largest driver of this business and is probably one of the most mind-blowing segments in all of the market right now. For a very long time, Google's cloud division was seen as being behind. It couldn't keep up to AWS, couldn't keep up to Azure, whatever it may be. I think they're becoming number one. I think there's very little question that they are one of the best cloud platforms on the market today. They're one of the faster growing, and they're starting from a much smaller base. So the trajectory for growth is potentially a lot more meaningful than a company like Amazon, who has a much larger base to work off of. So we come here, we're seeing 63% increase in revenue to $20 billion. So obviously when you have a cloud platform like this, it's going to be much higher margin than a lot of other services. So we're looking at operating income increased 30% and operating margin expanded by 2 percentage points to 36.1%. 36% operating margins and expanding operating margins for one of the largest companies on the planet is insane. It's insane. This company is so profitable that, and I mean, I'll get to the capital expenditures in a bit, but they're able to roll out capex, hundreds of billions of dollars in capex, and they're not even really putting all that much strain on the balance sheet. And one of the main reasons for it is they are just ridiculously profitable. So some other highlights, obviously we have that other income, net gain 37.7 billion. That's what I was talking about previously. And the company announced a 5% increase to the dividend. So if you're a dividend growth investor, you're getting a little bit of it from Google. So we looked at the overall makeup of this company. Search obviously still dominates, but what a lot of people believe for a very long time is that this segment would slow. It's not slowing at all. I mean, we look to 2025, we're talking about 50 billion, 50.7 billion in revenue, and now we're 60. We come to YouTube ads, again, double-digit growth, smaller portion of the business, but one that is growing quite a bit. And we look to Google Cloud. So we're talking about total revenue of 109 billion. We're looking at Google Cloud of 20 billion, growing at a 60% pace. It does not take very long for a $20 billion base growing at a 60% pace to actually get to the point where this could realistically outpace Google search and become the largest segment of the business. And I'll get to the backlog in a bit, which kind of should show you, why this is it's realistically possible. That is how much this company is crushing it right now. This is the 11th consecutive quarter for double-digit growth for Alphabet. And if we look to 11 quarters ago, that would have been around 3 years ago. That would have been the very, very early stages of LLMs, the early stages of something like ChatGPT. This is at the point in time where the market was extremely bearish on Alphabet. And all it has done since then is delivered. I mean, there's absolutely no question about it. If we come to Google's search revenue, I mean, we can see back in 2022 is around 162 billion. I mean, it's been nothing but up and to the right since. We're sitting at 234 billion over the last 12 months. And I mean, there was no dip here. There wasn't even a question as to whether or not this company's, search area would be disrupted by AI whatsoever. And if we go to the YouTube side of things, I'll kind of show you the acceleration in YouTube ads, which is, kind of that element, I think, that barrier to entry. So we have, a big spike up from the pandemic, and this primarily would have been, people. YouTube became a very popular investing platform because right around these 2 years here would have been full-blown lockdown mode. Everybody would have been on YouTube. Everybody would have been working from home, whatever it may be. So a lot of advertisers seen this as a prime opportunity to get on the platform. But if we look to the acceleration post LLM, we can see 31.5 billion here. We're looking at 41.3 recently, but there was a large jump here that was kind of out of the norm. Now, the only difficulty now is we are seeing this slowing down a bit. This isn't really all that surprising considering the tailwinds that Google had coming out of COVID, and the barrier to entry element there in regards to video advertising. But I would still expect this segment to grow at a double-digit pace. Not really concerned all that much. Sure, it's not as impressive as cloud, but this is a huge segment of the business still growing at a double-digit pace. It really does not have a segment right now that is not growing at that pace, which is, kind of greater than the sum of its parts. And when we come to the cloud chart here, this is where it truly does get impressive. We look to the company back here, it was definitely growing. We have to remember, back in 2017, this was a $4 billion business. And now we fast forward here, we're looking at last 12-month revenue of $66 billion. And even if we go back to 2021, it's nearly tripled in revenue. So this is a main driver of the business right now. And I think what a lot don't realize is, 3-4 years ago, this was a cash burning, segment of the business. We looked at their operating income, for 3 years here, or actually 5 years, sorry, it was pretty much, posting losses. And now we're seeing operating income just launch. We're looking at 1.7 billion in 2023 to 18.3 billion. A 10x in operating income in just 3 years. Final thing in regards to Google Cloud, just the business overall, is the backlog. This is one of the wildest charts you will see in quite some time. We look to backlog growth from, 2019 to 2024. It was pretty reasonable. It was still growing at a pretty, decent pace. If we isolate out the last few years and we go to 2023, we're looking at a compound annual growth rate of around 60%. Pretty good. And if we add the recent increases, which, absolutely absurd, launch pretty much straight north, we're looking at a 80% compound annual growth rate. The revenue backlog has grown almost 4,000% since 2019 to 2025, the last 12 months. We're looking at 11.4 billion versus 460 billion dollars. And what is this coming from? Well, first off, Alphabet, they literally cannot expand fast enough. They said there is a computing issue that they're dealing with here, and they are spending money in order to try to satisfy that demand. There is no, it's blatantly obvious, there is no demand problem here. Right now, it is a supply problem, and it's a good supply problem, which is why Google is rolling out an insane amount of capital expenditures, and the market does not seem to mind, because you are starting to see this show up in the numbers. For a very long time, a lot of this capex was potentially catastrophic, depreciating assets that never really turn any sort of profitability. They hit the income statement eventually in the form of depreciation, impacts earnings, all that type of stuff. You are just not seeing this with Google. It is starting to show up in the results. So when they say they are going to ramp up spending, the market generally approves. The reason they approve is because of that massive backlog. If we look to the capital expenditure side, we are seeing spending of around $35 billion on the quarter. We're seeing the last 12 months around $109 billion, and the company has raised its full year 2026 spending to around $180 or $190 billion. So right now, they are not spending to that pace. $35 billion in capital expenditures works out to be around $140 billion on the year. So you are going to see this ramp up in the back half of the year. And the craziest thing is the company mentions that 2027 will be significantly higher than 2026. what is significantly higher? This is actually the main question a lot of investors are asking right now. I mean, if we go to the company's capital expenditure charts over the last few years here, we can go to financials, cash flow statement, and we will get to capex. I mean, this is a company that's spending has absolutely ballooned. I mean, we're looking at around 25 billion in capital expenditures in 2021, and we are spending like mad. We're going at 110 billion. If we look to those forward estimates of 180 or 190 billion this year, realistically, if significantly higher means, let's just say 250 for the most part, they will have 10x'd their capital expenditure spending from 2021 to 2025. That is massive. So right now we're seeing a lot of pressure on free cash flow. It was down around 47% on the year. But the one good thing is they are not having to strain the balance sheet much at all with all this capital spending. And if we come to the balance sheet and we see long-term debt, yes, we can see that for quite a few years, Alphabet was paying down debt. It only had around 10 billion in debt at the end of 2024, and now we've launched up to 77 billion. But when we compare this to actual free cash flow numbers, if we come back to the cash flow statement and just add free cash flow in, this is a company that can very easily service the debt load it has right now with, I mean, just a little over a year's worth of free cash flow. This company is spending 180, 190 billion dollars a year in capital expenditures, is expected to in 2026. And they still have enough free cash flow to effectively eliminate their entire long-term debt in just a little over a year. And when we look to the cash on the balance sheet, it's got around 38 billion in cash. So when we subtract that from the long-term debt, I mean, it would only take around, this company is probably net debt around, just under $40 billion. So 8 months worth of free cash flow pays off this company's entire debt load. It's spending this much, but it is not doing so issuing debt, issuing equity, things like that. It's doing it, it's self-funded, which, ultimately, if you are issuing less equity, if you're issuing less debt to fund these capital expenditures, you can earn a higher return on them because it does not really cost you anything. So is the company a buy today? Would I still be adding to Google at 7% of my portfolio, all-time high prices, and these current valuations? So if we come down to the valuation segment of my reports over at Stocktrades Premium, we can see I've ran some relatively simple discounted cash flow analysis on earnings per share. So base case, which would factor in probably a 20% margin of safety, and at kind of the midpoint of growth, we're looking at 27% above a buy target, which is perfectly reasonable. And I think right now the market is not pricing in middle of the line case. They are pricing in what the company is delivering right now, which is currently well above expectations. If we come to a more aggressive model, which would be the company hitting the most bullish case, in my opinion, and a minimal margin of safety, I believe it's around 15%. We're looking at 4% above target. So this company is really not all that expensive. And if we look to a price to earnings chart, the company is, is it bordering on expensive? Yes, but it's really not that bad. I mean, we have just hit the expensive level of valuations. I mean, just a few weeks ago, this company would have been what I considered cheap. I mean, it was below the cheap line in terms of the calculations as to how I derive valuation in terms of price to earnings. But I mean, this company, there was a lot of opportunities here to add this company at some very attractive prices. Is it fully valued now? Does it need to deliver? Absolutely. But I mean, when you look to the fundamentals of this company, this thing scores nearly a 10 out of 10 in terms of profitability, risk 8.5, returns obviously outstanding, debt, I went over the debt, shareholder returns 5.1. Obviously, this isn't going to be too material because the company does not pay all that much of a dividend. Management 8.7, and momentum. Obviously, hard to argue momentum at this point, 8.7. The company is one of the best graded stocks on the premium universe. It is a foundational stock over at Stocktrades Premium. You can see up here, it has been since 2020. The one area you're going to see the company look extremely expensive is price to free cash flow. And obviously, when the company is spending so much, you're going to see a decline in free cash flows and an increase in the price to free cash flow multiple. This is really not all that surprising. You need to be looking at this company from a wide variety of valuation metrics. Price to free cash flow, I would argue, is not the best one because the company right now is intentionally reducing free cash flow by investing more into that demand side on the cloud business, and ultimately free cash flow will normalize, will start to increase as capital spending goes down. Now, when that happens is anyone's guess. This whole AI build out could last for years. So you could see this company look very expensive on a free cash flow multiple for a very long time. But I don't think you are getting a bad price on Alphabet whatsoever. If it continues to deliver the way it is right now, a $500 share price is really not that far of a stretch. This would make it around a $5.5 trillion company, which I don't really think is all that outrageous considering the results. So would I add to Google today at 30x forward earnings or whatever it may be? I think that forward earnings multiple is going to come down. I think you're going to see analysts upgrade earnings targets in the future. So this one is probably going to normalize at 24, 25x earnings. And in my opinion, there is a lot worse companies trading at much higher valuations right now. This company is executing in pretty much every way imaginable, and for many years, many years, people were writing this company off. They were treating it as a cyclical ad company. It's really just not that anymore. There's a ton of subscription-based models in the YouTube platform and the Gemini platform that is kind of moving away from that cyclicality and this cloud demand. I just don't see it slowing down much at all. Now, would I personally add right now? Probably not, because the company is 7% of my portfolio. If it was 5%, I would have no problem buying. If it was 3.5%, I would be buying all day here. It makes up a large chunk of my portfolio right now. I typically don't like companies to hover, above 7%. I'm usually comfortable with these mega caps being 5 to 7%, but there is no doubt if it made sense for me, I would be buying here. I see a long runway for Alphabet in the future. So that's it for the video, everybody. Again, if you like videos like this, head down below, subscribe to the channel, like the video, comment down below. Let me know what company you want me to go over next in terms of an earnings basis, and we'll see you next time for more great Canadian content. And just grab that free report on my top 4 holdings in the description below.